Welcome to Talk Tickers. We're your shortcut to understanding what's really driving the market, straight from the source, the earnings calls.
That's right. And today we're jumping into Renaissance Corporation's Q2 2025 earnings.
Yeah, and this one's a biggie. It's really significant because it's the first time we're seeing a full quarter of results after they merged with First Bankshares.
A major event for them. We've listened to the call, pulled out the key stuff, and we're ready to break it down for you.
Exactly. So let's get straight to it. What jumped out right away? Well, the headline numbers first. Reported earnings came in at just $1 million. That's like 1 cent per diluted share. Seems pretty low, right?
Yeah, on the surface, not great, but that's why you have to look at the adjusted figures.
Absolutely. Adjusted earnings were, get this, around $66 million. So 69 cents per diluted share.
A huge difference.
Massive. It just screams that those merger-related expenses really dominated the reported number. It's like classic integration noise.
Exactly. It hides the real performance underneath. And speaking of performance, the balance sheet looked pretty healthy.
It did. Loans were up $312 million compared to the combined figures back at the end of March. That's a 7% jump.
And deposits kept pace.
Mirrored it perfectly.
Yeah.
Up $361 million, also 7%. So good growth on both sides.
Nice. And what about the margin, the net interest margin, or AM?
Also moving in the right direction. The core NM, which is probably the cleanest look, went from 3.42% up to 3.58%.
Okay, solid expansion there.
And the reported NM, which includes some of those purchase accounting effects, jumped even more, from 3.45% all the way to 3.85%.
Wow. So even with all the noise, as you called it, the underlying engine seems to be running pretty strong.
That's exactly how it looks.
You strip away those one-time integration costs, those accounting adjustments, and the core business is actually showing real strength. Good growth, improving margins. It's setting a foundation.
Well put. It's like seeing the solid frame of a house, even while the drywall dust is still settling. So, okay, let's dig into how they're managing this massive integration.
Right, the merger itself.
So the deal with First Bankshares closed April 1st, bang on the start of Q2. So these numbers really are the first clean look at the combined company for a full 3 months.
And how's the integration actually going? Management seemed pretty positive on the call, didn't they?
They did. They used the word well to describe the cultural integration. Employees, customers, apparently blending okay so far.
Which is huge. You can't underestimate the soft stuff in a merger.
Definitely not. Now, they do have the big systems conversion coming up in early August. That's still a hurdle.
Always a tense moment, systems conversion. But good cultural fit helps smooth that over.
Hopefully. And just to give a sense of scale here, the assets they brought over from First Bank, fair value was $7.9 billion.
Wow. And loans within that.
$5.2 billion of us loans. And on the other side, liabilities assumed were $6.9 billion, mostly deposits, $6.4 billion worth.
That gives you a real sense of the size. And from an accounting view, you mentioned goodwill and intangibles.
Yeah, preliminary goodwill was pegged at $428.7 million, and core deposit intangibles at $159.6 million.
So that goodwill, nearly $430 million. That's basically what Renaissance believes the sort of intangible value of First Bank is worth, right? Beyond just the loans and deposits, their brand, customer loyalty, that kind of thing.
Exactly. It's a bet on future value creation, future synergies. And crucially, they mentioned all their regulatory capital ratios are still well above the minimums. They're still well capitalized, even after swallowing a bank that size.
Good. That's table stakes, really, but important to confirm.
So let's shift gears a bit. What's driving the actual profit, the efficiency?
Yeah, the engine room.
Adjusted pre-provision net revenue, PPNR, hit $103 million. Pretty strong.
And that's driven mostly by...
two things, really. That net interest income growth, which came from the better NI we talked about.
Right, making more on each dollar.
And just having a bigger balance sheet overall. More loans, more deposits, basic blocking and tackling, but done well.
Makes sense. What about non-interest income, fees, and that sort of thing?
Also looking positive. It hit $48.3 million in Q2. That's up $1.9 million from Q1.
And how much of that came from the newly acquired First Bank business?
A good chunk. $9.7 million of that increase was directly from First Bank. So immediate contribution there.
Good to see.
And beyond that, the mortgage division had a pretty solid quarter. Income there was up $1.6 million from Q1, and that's excluding a gain they had on selling some MSR assets, so some real organic strength in mortgage too.
Okay, mortgage bouncing back a bit. Now, the other side of the coin, expenses.
Right. Non-interest expense reported was $183.2 million. But again, you got to adjust.
Pull out the merger costs.
Exactly. Take out the $20.5 million in merger and conversion stuff, and it drops to $162.7 million for the quarter.
Still some more merger costs to come, though, right?
Yeah, they flagged about another $25 million expected in the second half of the year, mostly hitting in Q3, probably tied to that systems conversion we mentioned.
Okay, makes sense. But the underlying efficiency, how's that looking?
This was actually pretty impressive. The adjusted efficiency ratio improved by about 7 percentage points.
7 points. That's substantial.
Yeah, and they said it's now comfortably below 60%. And this is before they've even realized all the planned cost savings from the merger.
So they're ahead of the game on efficiency.
Seems like it. They sounded confident they're still on track to hit all the modeled synergies by the end of the year, which honestly, given the scale here, speaks well of their execution so far.
Definitely. Getting costs out quickly while integrating is key. Okay, so operations look solid, efficiency improving. What about the growth outlook? Balance sheet health.
Management said loan and deposit pipelines are basically holding steady compared to Q1.
Which was a strong quarter itself, wasn't it?
It was, yeah. Q1 was up from the quarters before it. So holding flat now isn't bad news. It suggests continued solid demand, especially, in those Southeast markets they like.
Right, attractive footprint.
And they stuck to their guidance for mid-single-digit loan and deposit growth for the rest of 2025. Seems achievable.
Okay. Any potential headwinds? Payoffs, maybe?
They mentioned that. They expect loan payoffs to pick up later in the year. Hasn't really happened yet, which has actually helped growth stay strong so far. But it's something they're watching.
Gotcha. Always a factor. Now, super important, asset quality, credit. How's that looking?
Generally, okay. Seems to be the message. Pass-through loan percentage improved. Non-performing loans were flat compared to last quarter.
Flat is good. No big increase in problem loans then.
Well, there was an uptick in classified loans.
Yeah.
But management was really clear on this.
Okay. What was the explanation?
They said it was mostly due to layering in the portfolio from First. Basically, bringing First Bank's existing classified loans onto their books. Not, they stressed, because their loans started going bad.
Ah, okay. That's a critical distinction, acquisition accounting versus actual new problem.
Exactly. The provision for credit losses, excluding the sort of day one stuff you have to book for acquired loans, was $14.7 million.
Okay. And charge-off, actual losses realized.
Net charge-offs were $12.1 million. But again, context is key. They said this was largely just two specific credits.
2 loans driving most of it.
Yeah, and they explicitly called them non-systemic, meaning these were specific situations, not a sign of widespread rot in the portfolio or the economy hitting them hard.
Okay. Isolating the issues, that's reassuring if true. And the overall allowance, the rainy day fund.
The allowance for credit losses, the ACL as a percent of total loans, barely budged. Increased just 1 basis point to 1.57%. So a tiny bit more conservative, but essentially stable.
Right. So the message on credit seems to be, a couple of specific charge-offs, some noise from bringing First Bank's book over, but the underlying trend is stable.
That's the takeaway.
And management gave some color on future charge-offs too, right? They expect things to normalize.
They did. They basically said, look, we had a couple of bumpy quarters cleaning up some problem assets, but going forward, expect the run rate to settle back down to around 10 to 15 basis points.
Which is more in line with their historical levels.
Exactly. Suggesting these recent bumps were, hopefully, temporary cleanup, not a new trend.
Okay, good context. Let's circle back to the net interest margin. What's the outlook there?
They're focused on the core NEM, and they see modest expansion continuing in Q3, maybe a little less expansion in Q4.
So still growing, but maybe the pace slows down a bit later in the year.
That seems to be the idea. They gave the June spot core NEM as 3.60%, just as a recent data point. But they warned, monthly numbers can bounce around a lot.
Sure, 1 month doesn't make a trend. And what about interest rates? The Fed, does their outlook bake in rate cuts?
It does. They said their outlook already includes 2 rate cuts later this year, September and December, probably.
And the impact of those cuts?
They expect it to be de minimis on their margin guidance. Minimal impact.
Okay, so they feel reasonably well positioned for a couple of cuts. That's good risk management.
Seems like it. And one last piece on NEM, that purchase accounting accretion, the extra income from acquired loans.
Yeah, how much was that and what's the outlook?
Total for Q2 was about $16 to $17 million. They broke it down a bit. There's a sort of normal or predictable part, which is about $13 million. They said that's a pretty good proxy for Q3 and Q4. Okay,
so maybe $13 million per quarter going forward from that piece.
Roughly. But then there's an accelerated piece that was just under $5 million in Q2. That part is much harder to predict, depends on how quickly certain loans pay off. So that adds a bit of uncertainty to the reported INI.
Got it. So core NIN expanding modestly, reported in getting a boost from accretion, but that boost might fluctuate a bit.
That's the picture. So, okay, after all that detail, let's pull back. What does this all mean for investors? For you, just trying to understand the company's trajectory.
Yeah, the big picture.
Well, management sounded really confident. They said they're right on track with the big strategic goals they set out over a year ago.
Which included hitting student return targets.
Yeah, getting return on assets, ROA, up to the 1.25% to 1.30% range.
Yeah.
And driving that efficiency ratio down to 56%.
Ambitious goals.
Definitely. And they really believe this merger is the key. They use the phrase unlocking potential on both sides, combining strengths. These Q2 results are kind of the first proof point of that strategy working.
And how are they thinking about using their capital? Now that they're bigger, generating more earnings, where does the money go?
They laid out a very clear pecking order. Number one priority, fund organic growth. Feed the core business.
Makes sense. What's next?
Second is small bolt-on acquisitions. Not huge deals, but things that add specific expertise. They mentioned specialty finance areas like factoring or asset-based lending, buying know-how.
Smart, targeted M&A, okay.
Third is talent acquisition, hiring good people. Fourth, they mentioned securities portfolio restructuring. They've already done a couple of those, actively managing the balance sheet.
And buybacks?
Buybacks are certainly on the list, they said. They know they're generating capital quickly, but it's not the top priority right now. Organic growth and those bolt-ons come first.
And big M&A.
Yeah.
Another major deal.
That's last on the list. They want to keep capital available for potential future whole bank deals down the road, but they were crystal clear. That is not a near-term focus.
So a very disciplined approach. Growth first, then targeted capability buys, then maybe buybacks, with big deals way off in the future.
That's exactly it. And tying into that, their current M&A stance is, well, absolute focus on the First Bank integration.
Laser focus.
Totally. They said it's squarely their priority because it has the most meaningful impact for shareholders right now. They don't want anything to derail realizing the benefits of this deal.
So don't expect them to announce another big acquisition anytime soon.
Extremely unlikely. They're all hands on deck for the integration. Now, that focus is good for execution, but what does it mean strategically? Does it limit them while competitors might be looking at deals?
Yeah.
That's something for you to think about.
That's a fair question. This intense focus signals deep confidence in the value they can wring out of this merger. They think the best return is optimizing what they just bought. And remember, that First Bank deal also helped their interest rate risk profile.
Right, you mentioned that. How so?
It made Renaissance a little less sensitive overall to potential Fed rate cuts. First Bank's balance sheet complemented theirs in a way that reduced their exposure. So that's a nice side benefit in this environment.
Okay, reduced rate risk. What about upside? Where's the untapped potential now that they're bigger?
Management highlighted quite a few areas. That mortgage business rebound we talked about. It's getting an extra boost from being in these new growing Southeast markets. More people moving in, needing mortgages.
Okay, demographic tailwinds.
Then there's treasury management, converting former First Bank business clients over to Renaissance's treasury solutions. That's apparently ongoing and still has upside potential. More fee income.
Right, cross-selling opportunities.
Exactly. Plus, growth in capital markets, other fee income lines. They said the new teams are integrating well and adopting products quickly. And maybe the most interesting part, early wins in those secured lending areas, asset-based lending, factoring, equipment finance, and just being able to handle larger loans now with their combined size. They're winning deals neither bank could have won on its own before.
Ah, so real revenue synergy starting to show up, not just cost cuts.
Precisely. Tangible benefits from putting the two banks together are starting to flow through. New growth avenues opening up.
Okay, lots to digest there. Now, before we finish up, it's time for our segment called This Is Not Financial Advice.
Let's be absolutely clear here.
Crystal clear. What you're about to hear is just us thinking out loud, a speculative idea based on the call. It is not investment advice. Don't go trading based on this. It's purely for informational, maybe entertainment purposes. Got it.
Absolutely. Do your own homework. Okay, disclaimer firmly in place.
Certainly.
All right, so playing the role of hedge fund analyst for a moment. Here's a potential trade idea based on this Renaissance deep dive. Consider going long Renaissance Corporation stock. The thesis. Expect a significant re-rating of the equity valuation maybe kicking in by early 2026.
Okay, long renaissance, re-rating by early 2026. What's the rationale?
It's really four key things we've just discussed. First, that unwavering execution focus. Management is obsessed with getting this integration right, even pushing other M&A aside. That screams confidence and dramatically lowers the execution risk compared to other messy mergers you sometimes see.
Okay, reduced risk premium. What else?
Second, efficiency gains are ahead of schedule. They're already comfortably below 60% adjusted efficiency, with more cost cuts coming. Their target for a clean income statement by Q1 2026, showing all the synergies. That could be a major positive catalyst the market isn't fully pricing in yet. Once the noise clears, the underlying profit power could surprise people.
Right, the clean numbers could look really good. Third point.
Third, growth is fueling the gains. That steady, mid-single-digit loan and deposit growth, the strong pipelines, those untapped fee opportunities in great markets, it provides the top-line momentum to really leverage those efficiency gains. It's not just cost-cutting, it's profitable growth.
Makes sense. Growth plus efficiency equals better profits. And the last piece.
Fourth, capital strength and discipline. They're generating capital fast, but they're being smart about using it, prioritizing organic growth, strategic bolt-ons, not just rushing into buybacks. That builds a stronger balance sheet and keeps options open. It reinforces the quality story.
Okay, so focus, efficiency, growth, discipline. Any way to refine that trade? A hedge, maybe?
You could think about a relative value play, go long Renaissance, and simultaneously short a regional bank peer that seems less disciplined, maybe facing bigger integration hurdles or worries about credit quality. If Renaissance executes like they say they will, that performance gap could widen, enhancing the return, exploiting the divergence based on execution.
Interesting angle. Okay, so that's the speculative trade idea. Remember, everyone?
Not financial advice.
Definitely not.
Yeah.
So let's wrap this up. What's the bottom line on Renaissance's Q2?
I think it's a story of strong execution. They're navigating a complex merger, and the underlying results look really solid.
Yeah, the core message seems clear. Underlying performance is good, they're on track to get the promised synergies, and management is laser-focused on making this First Bank deal a success.
That sums it up pretty well.
And one last time, nothing we've discussed here is advice. It's just to help you, our listeners, stay informed.
Please be careful out there.
So here's a final thought to leave you with. As Renaissance gets past the heavy lifting of integration, the systems conversion, as they start really leveraging this bigger scale and their disciplined approach, what other opportunities might pop up for them? What potential hasn't the market fully grasped yet? Something to chew on.
Definitely something to watch.
Thanks for tuning in to Talk Tickers. We'll catch you on the next deep dive.